The EU's insurance watchdog is tightening the screws on crypto. The European Insurance and Occupational Pensions Authority, or EIOPA, has just dropped a major recommendation, and that is that insurance companies holding crypto should face a 100% capital requirement. In other words, every euro insurers hold in Bitcoin, Ethereum, or any other digital asset needs to be fully backed. So no leverage, no wiggle room. And so in this video, we're going to be looking at whether this is the latest sign of crypto skepticism from European regulators or a justified risk measure. Let's break it down. The EIOPA has officially advised the European Commission to impose this one-to-one capital requirement across the board, and it doesn't matter whether an insurer holds crypto directly or indirectly. If it's on their books, they must match it entirely with capital reserves. And so this means that insurers will need to significantly rethink their approach to digital assets. Currently, some firms use a risk-based approach where capital requirements fluctuate based on asset volatility, but the EIOPA is taking no chances. And this rule would apply universally, regardless of how crypto is classified on the balance sheet. And some industry experts believe that this could discourage insurers from exploring crypto investment opportunities altogether, whereas others are arguing that it just simply reinforces the need for a safer and more regulated digital asset environment. And so why are the EIOPA making this recommendation to the European Commission? Well, their reason is that crypto is simply too risky, and they have four main points to make around this. And one is that the crypto suffers from extreme price volatility. Secondly, being that there are market manipulation risks. Third, there is a lack of price transparency. And fourth, low liquidity. And the regulator believes that these factors make crypto too unstable for insurers to hold without full capital backing. So in their words, 100% haircut in the standard formula is prudent and appropriate. And to put this in perspective, if you imagine a major insurance firm allocating a portion of its reserves to Bitcoin, if the value of Bitcoin crashes overnight, the firm could face sudden financial stress. And so by enforcing a 100% capital requirement, the EIOPA is ensuring that such risks do not compromise the financial stability of insurers or their policyholders. But, is this a fair assessment? Well, critics are going to argue that other asset classes like equities or real estate, property, also experience volatility and downturns, yet they are not subjected to such stringent requirements. So why single out crypto? Now, despite all this, EU insurers are not exactly diving headfirst into crypto. In Q4 of 2024, the total crypto holdings by insurers across the block amounted to just 655 million euros. And I know that sounds like a lot of money, but that is actually only 0.0068% of their combined 9.6 trillion euros in total assets. So in other words, this is actually a drop in the ocean. And currently, EU insurers allocate capital equivalent to around 60 to 80% of their crypto assets, but EIOPA wants that pushed to a full 100%, effectively discouraging exposure altogether. So why impose such strict measures on an asset class that insurers barely hold? And I think what's actually going on here is this is kind of a preemptive move to prevent future risks rather than trying to address an existing problem, because there isn't an existing problem at the moment because they don't hold enough crypto. And regulators have often been accused of playing catch up with financial markets. So it seems like in this case, they're trying to get ahead of the curve. And this move actually fits into a broader pattern because across the EU, regulators are tightening oversight on crypto, from these new MiCA regulations to stricter banking rules. And while policymakers are fine with allowing crypto to exist, they're not making it easy for traditional financial players to actually integrate it. For example, under MiCA, crypto firms are going to have to comply with extensive licensing requirements and disclosure obligations. Meanwhile, banks looking to hold crypto have to set aside more capital to cover potential losses. Now, we've got insurers facing a similar barrier. So it's clear that EU regulators are making it as difficult as possible for institutions to get involved in digital assets. Now, you might argue that this is overkill, but some people would argue that insurers should be allowed to manage their own risk. You've got others that will think that these rules, signal growing institutional distrust of digital assets. Whereas the regulators themselves are going to obviously say that this is simply about financial prudence. And crypto markets are still relatively young, and with high-profile collapses like FTX, traditional institutions need to be protected from the worst-case scenarios. This is what the EU will be telling us anyway. And if the industry can prove that it's matured, then perhaps these strict requirements will ease in the future. So what do you think? Is the EU regulator playing it safe, or is this another unnecessary crackdown on crypto? Let me know in the comments below. And if you want to stay ahead of all the biggest crypto regulation updates, make sure to like, subscribe, and hit that notification bell. Thanks for watching, and I'll see you in the next one.